Hi, my name is Bob Brooks, and I want to talk to you about how the stock market really works over time. You know, if you talk to anybody in the industry, this is what they'll tell you. They'll tell you that the market always goes up. And they'll show you this big, long chart that shows the market always going up. So you look at that and you say, well, that makes sense. You buy and you invest for the long term. You stay invested because the market always goes up. I'm going to show you some information today that might really surprise you. In fact, it's information that I don't believe that the majority of the industry actually even knows about, and is taking a historical look at how markets work. Now, let me show you something real quick. That when I start talking about how markets work and I start showing charts, there's this tendency for you just to glaze over. I'm convinced that sometimes people get very nervous and anxious when they get around charts that they're not going to understand it. I'm going to show you real quick how to understand how to read a chart. When you look at a stock market chart, you're looking at the market either going up or down, and you look something like this. Just think of it this way. Think of your money invested in the stock market, and this is the value of your account. It's going up, it's going down, and that's the best way to interpret these charts. Because I think it's important to really understand how the markets really do work. And once you see this, I think you're going to view risk differently. Incidentally, this comes from a book called Stock Cycles by Michael Alexander. I think it's a great work, and what I've done, he's actually taken this through 2000. I've updated a bit to show it how it looks today. Now, this first chart, where it says 1900 to today, and that gives you a very long-term look at how the market works. Now, if you look at that chart, somebody in the industry will say, look, the market has gone up over time. Sure, it's gone down for a period of time, but it always goes up. And they kind of leave it at there. But what I like to do, I like to take this chart and break it down to smaller segments. So let's go to this next chart, 1900 to 1921. Look at the far left-hand side there, and you'll see starting out there where the market started, and then at the end of 1921, it is actually lower than when it started. That's what's called a long-term bear market cycle. And then, if you look at 1921 to 1929, that was an incredible time to be invested in the stock market. People were very happy to have their money growing like that. Then you have this mess, 1929 to 1942. Are you seeing a pattern here, how it goes from one long-term trend to another long-term trend? But 1929, look at that. Look at the dramatic drop in the price of stocks over that time period. And that is a long time period. Then you look at 1942 to 1966. Look how the market went up and put in a big bull market over a very long period of time. And then you have this mess, 1966 to 1982. Look at that. The stock market was all over the place. And you went from 1966 to 1982, which is 16 years, and basically you lost ground in the market. And then we go to 1982 to 2000, and you see one of the greatest bull markets of all time. And then, of course, who can't forget 2000 to 2002. And look at the way that this, we all remember how bad the market was then and how much people lost. And, of course, we had this final one, 2002 to now. And of course, now is the big question. Are we switching back into a bear market? That's the big question. I actually believe that we are. Of course, the proof is still out, but I will say this, the market has had a tough time since last October. This is my concern, is that most people who are investing today started investing in the 80s and the 90s. You remember this chart where the market was going up. And so this is really all most people know, is that the market always goes up. However, if you would have been invested in this market between 1966 and 1982 and gone through all that incredible frustration with the market going up and then the market going down, I think you would view risk differently. Now let's look at a chart that Michael Alexander put together, and I think that this really explains things very well. Now when you're looking at this chart, once again, don't glaze over on me. Hang in there with me because this is really important. On one side of the chart, it says out of balance. And in the other chart, it says imbalance. And what happens is that the market goes through a period of prosperity, a bull market. It does really well. But what happens is that things get out of balance. And then we go through these long-term bear markets where the market goes down to get things back into balance. So look at this chart. You see on one side, you have out of balance, long-term bear market, and then you have in balance, long-term bull market. And you can see it goes from one period to, like it goes from a long-term bear market to a long-term bull market. It goes backwards and forwards. And you'll look at the number of years that these cycles, and that's what this is called, a long-term bear market cycle or a long-term bull market cycle, but you'll see how many years they actually lasted, and they last for a very long time. Then you look at annual returns. There's a huge difference between the annual returns between a long-term bear market and a long-term bull market. But it keeps going back and forth and back and forth, out of balance, in balance, and vice versa. Now let's go down just a second. 1966 to 1982 was 16 years, annual real rate of return, negative 1.5% per year, over 16 years. Then you go into a period that is great for the market, a long-term bull market, 1982 to 2000, 18 years of superior gains, 14.8% average, pretty good time. Now, let's go back over to the other side of the page, 2000 to 2007, and incidentally I added this to the chart, 8 years, 1.8% return per year. It's not good, even though you could be fooled by thinking of that we've had this great period of time, 2002 up until the top in 2007, 5 years of great stock market gains, but you average it out over time, and it really does give an example of how bad bear markets can be. You know, you could go through a 2-year bear market and wipe out a good 7 years worth of total investment time, and 5 of those 7 years would be of gains. This is why you have to protect against risk, and this is why risk is important.